they don't necessarily need to own any item, right, of themselves. They don't. And so they literally just, right? I thought this YouTube thing. Okay, I think we're good now. So they literally just have to, please, are we together? They literally just have to, um, find an opportunity to make some profits one way or the other. Yes, I'm so sorry. I thought our YouTube was ongoing. I never knew it wasn't, and I've gone to a couple of minutes. I think that's just going on live here. I would confirm right away. So that's very much important for every one of us to know. So thrift collectors go to the market. They are going there to collect savings of some persons who are, trading the financial markets, those who are trading beans and this particular commodity, they go there to go help them with their savings, and then that is how they make their own profit. So the marketplace is a interesting place because you can speculate on pricings, you can start up a business without winning anything, and most importantly, it's a place that should be open for a number of excuse me days. Some markets in some local regions, they open one days in every week, one day in every week. Some marketplaces and other places open 5 days in 7 days. I mean, real physical markets. But then coming to the financial market and crypto market, for instance, it's the market. The marketplace in cryptocurrencies allows you to buy and sell different digital assets. Bitcoin is a digital asset, and of course, you need to know that. Ethereum is a digital asset. All of these cryptocurrencies, over 21 million pieces of these cryptocurrencies, because up until 2020, we only had something around 20,000 cryptocurrencies. But now we have so much. Why? Because people can create their own cryptocurrencies. Now, that said, you need to just understand very importantly from this part of the slide that the role of the financial market, and we have financial market, different financial market, just like we have the crypto market, is to connect buyers of cryptocurrencies to sellers of cryptocurrencies, is to enable investment in cryptocurrencies and to grow their wealth in cryptocurrencies, is to provide liquidity. I hope you're aware. I mean, those are important things. And this is a crash course. I must tell you, if you're learning for the first time, you do a lot of reading, a lot of reading, a lot of reading. I'm not going to be promising, but if you can just help with discussing with our, community manager, she might, probably help so I can pull out some resources and send across to you people that would help you in your reading and your discoveries. You must do a lot of readings yourself on a very personal level. This is a crash course. Imagine you want to learn something that would take about 6 months for you to have a basic understanding in 2 days, right? You would really know that it's just going to be we scratching the surface. You need to do way more, right? So tomorrow we're going to be doing a practical of buying and selling cryptocurrencies. And trust me, if you've not signed up on BitGet, you might just be shooting yourself in the leg. This is your opportunity to get that done quickly, so you can actually tag along while we're doing the practicals. So the cryptocurrency market does all of those we've mentioned, and much more importantly, it allows you to speculate on pricings. Say like the example we gave of oil, that Bitcoin is going to be going this particular way or that particular way, and if you would definitely take advantage of that to make profit of the price difference. Let's say you knew Bitcoin was going to rise in price in about 1 quarter's time. 1 quarter meaning 3 months. You literally had to, get in and take a buy position because you feel it's going to be going upward based on whatever analysis you've done. And then the market price of Bitcoin went that way. Good for you. And then if you add this, analytical stance that the pricing of Bitcoin is going to come down, trust me, you also have the opportunity of taking advantage of selling the market. So by selling the market, you can, take advantage of the pricings in this asset and lock in on some profit. But unlike every other market, either physical market or the stocks market or indices market or mutual funds, right? Cryptocurrency market is open for 24 hours in 7 days. That is, even on holidays, be it Christmas holidays or New Year holidays or men's holidays or banking holidays, whatever holidays, the crypto market is still very much open, meaning you can always make money in cryptocurrency every day. But then, if you get into trading the market, you would come to understand something that you're not you shouldn't be trading every day. If you're doing that, you get yourself shot in the leg. You would be seeing what you're meant to see, and trust me, you'll be doing what you're not meant to do. And I tell you ahead, while we're going to look at the analysis later on, that you must come to the place where you must form discipline around trading, right? Very importantly. So let's head on to the next part, which is the overview of the financial market. So we have different types of markets in the financial, realm. Will I use the word realm? In the financial matrix, no, let me use a different word, in the financial spectrum, right? So in the financial spectrum, we have different markets. We have in the traditional market, and then we have in, which is inclusive of stocks, forex, commodities, mutual funds, indices, um, what else again? Mortgages. I mean, those are markets because we have MBS, we have mortgage-backed securities. Those are ways, or allowances for people to take advantage of investing. That's not common to us, mostly in Nigeria here. What are mortgages? They are just houses that are loaned out to people. That people pay interest. They pay money on until they either paid off or they keep paying interest while they're staying in those houses. Then, the investment banking system can allow people who are not in fact having houses to buy kind of shares into those mortgages. It's funny, but then those are ways of the investment bankers to profit and give room for investment for investors. But then there are different kind of market, and that's why I just stumbled into that mention. It's not even on the slide as you all can see. So traditional market, crypto market, those are the two major categorizations. But then under the traditional market, what you're saying is stocks, forex, commodities. Now we have, the stock market. You know what all these are about. Stocks are a um how do I say this now? A printed, will I use the word printed? A licensed produced unit of a company's security, allowing investors to invest directly into the company. I mean, will I say directly? Yeah, directly and indirectly into the company, giving investors ownership of the company. Take, for instance, you have in Amazon stocks, you have in IBM stocks, you have in Tesla stocks, you have in Microsoft stocks, you have in what else again? You have in Alphabet stocks, you have in X, or formerly Twitter stocks. Now, you don't own Twitter, but then you feel, because there is the stocks for Twitter, which is a, produced, or, you know, um, which is a manufactured unit of shares owned by the company, given to investor with the opportunity for them to invest into the company to the end that they might own a portion of the company. So imagine you're holding 1,000 units of Tesla stock. Well, that's a lot of money. I must tell you, one Tesla stock, as of yesterday, was trading at $397. So holding 1,000 units of Tesla stocks means you're holding almost $500,000. That's about $400,000, right? Holding $400,000 of Tesla stock, 1,000 units of Tesla stocks. Let's say there are only 10 million units of Tesla stocks. I mean, you want to point your calculators if you are right here with us in the class. There are 10,000 units of Tesla, stocks. I know, I think it's more than that, but just imagine that arbitrary figure. There are 10,000 units, and you alone bought 1,000 units of Tesla stocks, right? That implies that your 1,000 units, if you divide that by 10,000 units of Tesla stocks, or let me say 10 million units, 10 million units of Tesla stocks, that implies that the percentage of Tesla stock you're holding is 0.01. You're holding 0.1%, you're having 0.1% ownership on Tesla stock, and even having 1%. So if there are 10 million Tesla stock shares, and if, let's say, you got so lucky, you were able to hold 100,000 units of Tesla stocks, that's a lot of money. And you want to check how much that is. That simply means that you are holding 1%, right, of Tesla, and 100,000 stock, right, of Tesla simply implies that the value of your stock is currently at, if you multiply that by 397, it's at 39.7 million, or let's say 40 million United States dollars. Interesting, right? And so just imagine you got on Tesla stock, you bought Tesla stock some 10 years ago. Its price was definitely cheaper some 10 years ago. That implies that between the space of 10 years, your investment, say it was like $1 million, has gone from $1 million to about $40 million, which was about 40x profit within the space of 10 years, because you invested in Tesla stock. So I'm just making us to see the picture of stocks, right, and the numbers in between there. All right, but then that is an example of traditional market. And then you have in the forex market, which is the foreign exchange market, where currencies of different countries are traded against each other. United States dollar is traded against Great Britain pounds, or GBP. Canadian dollar is traded against Australian dollars. Japanese yen, JPY, is traded against Chinese yuan. So you have a different current, and just like that, we have in different countries' currencies are traded against each other. But those who are forex traders can actually leverage their brokers to profit off that. Who are brokers? Brokers are those who give retail traders. I will explain who retail traders are shortly. Brokers are those who give retail traders the allowance to take advantage of the price movement of different foreign currencies in the foreign exchange markets. I mean, those are brokers. They give retail traders the allowance to take advantage of they allow retail traders the opportunity to take advantage of price difference by giving them access of trading the financial market or the foreign exchange market, within different country currencies available in the financial market. So brokers allow retail traders to trade the foreign exchange markets. Those are what brokers are. Because an individual person back some 20 years ago, or let's say some 30 years ago, cannot trade the forex market. Those who trade the forex market are hedge fund managers. Those who are big money guys. Those who are trading, or those who are having maybe $1 billion asset under management, $200 million asset under management. But imagine some guy having just some random $100 or just some little $50 and saying, hey, I want to go trade. Back in the 90s, you can't trade. But brokers come into the picture and say, you know what, I can allow the small guys to trade. Why? Because I would give them leverage. And that's what brokers do. They give them leverage. That's the leverage that allows them to enter the financial market and trade. And so that is that about the forex market. And of course, you also have the commodities market, where you have different commodities: gold, oil, silver, platinum, zinc, lead. Different of these commodities. We also have cocoa. So all of these are traded also in the traditional market. So it's important for me to let you all know that these trades for stocks, forex, and commodities market is never 24 hours, 7 days. It has always been, maybe if to, I don't even think it's 24 hours. They have a closure time. I think most of the closure time is really for those trading the London market. Let's say those on the New York Stock Exchange, NYSE. It's closed. I mean, they close around 4 o'clock. Before 5 p.m., they are done with trading. They're done on the trading desk. Trading starts 8 o'clock, 8 a.m. UTC, 8 a.m. Universal Time Conversion. And this is the time where most trading activities take place, right? Between 8 hours of 8 o'clock and 4 p.m., say 5 p.m. Essentially. So that's the traditional market. Trading starts in the morning, let's say 8 o'clock, and it closes around 5 p.m. and it opens. That's stock market, right? It opens the new day maybe around 1 o'clock in the morning or midnight, right? But most traders resume on their desk around 8 o'clock. So, and of course, don't forget there are price different. There are time differences, which differentiates those who are trading different session. I will explain. So there is there is the New York session, there is the Tokyo session, especially for the forex market, and there is the Asian session. So they are different. There are about 4 sessions. So there is Sydney, London, New York, Tokyo. So there are 4 sessions that are tradable for the foreign exchange guys. Either ways, I must say something. Once it is 10 p.m. Nigeria time, right, for forex traders, they will not be allowed to trade again until the following morning, and that's going to be around 1 o'clock in the morning. And they will be able to do these trades of morning till 10 p.m. every day, for from say Monday morning till Friday night. And that's all. But then they are not allowed to do 24 hours trade every day for forex traders. Stock traders literally have to trade in the morning from around 8 o'clock, I think. And they are trading, sometimes it's 2 p.m. for some stock applications. For example, if you're using Nemo application, Nemo stock application, I'm giving us already free alpha. You can use Nemo to buy some stocks. So imagine you're using Nemo, and then you want to sell some of your shares or stocks. You cannot do that sometimes until maybe until around 2 o'clock, when some stock trade are allowed to be opened. So I'm saying there are the limitation of timings when it comes to the traditional market, be it stock market or forex market. And of course, the same thing goes for commodities market. But for cryptocurrencies, you literally can trade them even in the dead of the night on Sundays. Interesting, right? That's those are the edge that cryptocurrencies have over the traditional market. Plus, the fact is the decentralization. Cryptocurrency trading is very decentralized, and not just in the trading, the cryptocurrency market is decentralized. So we're having different types of exchanges. I must say this. So, what are exchanges? Just like the marketplaces I give reference to or mentioned the other time, exchanges are platforms where buyers and sellers connect to buy or sell their digital assets, um, leveraging the liquidity made available by the exchanges. So exchanges are the platform where you get to buy a particular crypto asset or sell a particular crypto asset, and you can also put in your liquidity, your money, and take them out, right? Those are exchanges. Long story short, example include Binance, Bitget, Coinbase, Gate, HTX, name them, Axendex. There are different exchanges like that, right? Okay, so then there is a place of the centralized exchanges. So this is it. Exchanges are of two categories. There are decentralized exchanges, there are centralized exchanges. Just like their names, decentralized exchanges simply means you have a decentralized access to the use of the platform, or let's put it this way, you have a decentralized access to the control of your assets and the use of the platform. Those are decentralized exchanges. But centralized exchanges means there is a centralized control of your asset and a centralized access for you to use the platform. So what do I mean? For example, if you want to use a platform like BitGet, you must not only give us your name, not me, I'm just saying, you must give the platform your name and then your verification or means of verification. That's your know your customer, KYC. So you either drop your NIN, your driver's license, your international passport, whichever. So you drop this so that we can know who you are. Why? Because this is centralized exchanges and they have to go through the government, and of course they must get licensings, and to be so sure you're not committing money laundering, they must have some of those informations, and that's why they are called centralized because of layers of controls needed to be put in place to ensure some level of assessment and checks are done to combat and to resist fraudulent activity. I mean, are we all still here together? Oh, great. Can we all see hear me? Just to check. Okay, great. Thank you. So now that is the place of a centralized exchange. But for a decentralized exchange, like I'll give us an example. I IPA is it IPA now or IPA exchange? There are different of them. There's so many of them. So like okay, let's give this example. Uniswap, PancakeSwap, those are decentralized exchanges. You don't need your name, they don't need your email, they don't need your anything, they don't need your whatever, they don't even need you to deposit fund to them. No. So you have your wallets. Now I would probably be talking over back and forth on all of these different mentions. You must try to read up on them. So there is a wallet, crypto wallet, which is just your a particular application that is not owned by anybody, that you can download, that you can use as a pause. You all know what pauses are, like a pause where you just hold your how pauses are just like a wallet, a pause like that, where you just have to store your cryptocurrencies. It's simple, and you have the right to define its security. If you lose that particular fund in that particular wallet, you have nobody you can ask for a recovery of your password, because wallets are not gated with password, they are gated with what is called seed phrases. They could be 12 in number or 24 in number. So you can download them. Examples include BitGet wallet. So I want to give us an assignment. Download BitGet wallet after this class and go have a feel of what the wallet looks like. I'm telling you, you would come to say that you'll be given a 24 seed phrase, and then you literally BitGet doesn't have control on your BitGet wallet, but they might have control. I mean, they have control on your BitGet exchange. So BitGet wallet is different from BitGet exchange. So there is BitGet wallet, there is MetaMask, right? There is Trust Wallet. Those are wallets, right? Nobody controls them. You do. And if you lose your 12 seed phrases, it's gonna. I remember a time a few years ago. I had a few funds on a particular wallet, and this was towards my finals. I mean, a couple of years ago, honestly. And I just realized that this particular coin, or name of the coin is PBR. I won't forget, as increasing value. And for some reasons, I just realized, wow, my God. And I was looking, so I was looking for the seed phrase. Apparently, I had changed my phone. I had to check my diary, and that's very important. When you get your 12 seed phrase, try to write it down somewhere, right? I had to check up my diary or some book where I'd had it written down before I could load up the wallet. And I realized that this thing that was worth $50 some month ago, right? It's now worth over $250. Yeah. Interesting. So this is many years ago. So the money is literally gone. So I'm saying this to just let us know something very importantly, that your wallet or your what's it called? Your seed phrases your access to your phone in your wallet. So that is what you need. I mean, your wallet is what you need to interact either buy or sell on a decentralized exchange. That's where we're coming from. And so they differ from a centralized exchange that all you need is your email and password. They create the wallet for you, they manage your wallet for you. But then if you forget your password, you can always click forget password, and they will send you an access for you to recreate a new password via your emails, right? And the other time, I just remembered I was about to explain to you who retail traders are. Retail traders are people like myself and yourself who don't have $2 million to go start an hedge fund. You have a couple of maybe $1, $2, $3. You're a retail trader and you will need a form of leverage to trade the financial market. We all are retail traders, right? Simple. So banks are they are the I don't want to call them wholesale trader, but they are the big guys in the market. So I don't know if you're aware, if you lock up your fund or you save your 200,000 naira in your bank and they promise to give you 3% at the end of the year, that money you have locked up there is a liquidity they can use. I must tell you, I don't know if you're aware, bank trade forex, the trade foreign exchange with the money. They also make a bit of profit, and it's from those profits either they also use that money to give out to, what do you call it? Big men who come to borrow fund for some of their investments. The big man come to borrow 500 millionaire, they just coup all the money in the account, which also is inclusive of yours, but of course they wouldn't tell you, to just meet the need of the big man, and then they give you 3% when the big man comes to refund. Or sometimes when they go trade forex, they also get the own profit. So they have the way they give you, they give you your share. So they're doing good, right? Isn't it? But I'm just saying this to let you know that banks also have, they also play an active role in the forex market. So this is all there is about the overview of the financial market. So the traditional market consists of both, stocks, forex indices, mutual fund, commodities, and those are pretty much all there is. In fact, inclusive of mortgage-backed securities. But then, the crypto market is very much different. It includes, Ethereum, Bitcoin, altcoins, and it is traded on exchanges, and it has 24/7, tradability. Right? Those are the differences. It is decentralized and it is volatile. Crypto is volatile. You can go check. So we made some days ago, we made an analysis that Bitcoin is likely going to be dropping to $100,000. The analysis is still live on X, right? We give the analysis from $115,000, right? And Bitcoin got there and then it's been tanking till now. So look at that, from 115 till now, it's about almost 10, 20, 10, 20, almost 10, 15%, almost 10 to 20%. Imagine if someone had leveraged it with a 10 times leverage. That means if you had shorts the market down with a 10 times leverage, since it went down about 15%, you will have been 150% in just 1 month. So no bank gives that in a whole 10 years. No bank. 10 years, 3% gives you 30% at best. So I'm saying this is the interesting part of the cryptocurrency market. Extremely volatile. That can always be potential profit and also potential losses. So let's move ahead. So the trading fundamentals. I think I'll just explain this briefly and then would continue going forward. Please, are we all still here? Okay. Okay. Thank you. Are we all here? Can we start? Okay. All right. So, yeah, let me share the screen again. Okay. So, I believe we can see this again. Can we see that? Hello, can we all see this? Okay, thank you. All right, all right. So once we've understood how the financial market or the overview of the financial market, especially for cryptocurrencies, operate, then I think some other important details are of great necessity. They are of great necessity. Now, the cryptocurrency market might look a bit funny now because the backstory of what led to we having cryptocurrency, I haven't mentioned that. So 2008, there was a financial crash that was an apparent result of misuse of funds in the hands of investment bankers and several other contributing factors, which also includes um, you know the way they were collateralizing and building securities. When I'm saying security, I mean asset that can be invested into. The way banking systems and banking structures in the US and in the global market were building assets for investments on houses in the US. So it was a contributing factor of um, it was a contributing factor of the no of the mishaps in banking, the contributing factor of how securities were built on collateralized mortgages or houses that led to a terrible financial crash. It was so terrible that the 2008 financial crash is etched in the mark of history. Now, the crash became so bad to the end that government now, of course, to combat that crash, they went on a printing spree. They were printing dollars and printing dollars and printing dollars, and of course, it was in the middle of this. Some persons who goes by the name Satoshi Nakamoto, who is the pseudonymous founder, and I mean the founder who is not known of Bitcoin, thought of, wait a minute, why don't we just create a financial system that is backed on mathematics and economics? There is a maximum unit of Bitcoin. I mean, or a maximum unit of a particular coin that will be in circulation, and the particular coin in this context was Bitcoin. So it has a maximum unit nobody can print again on it. And of course, don't forget, the value of money increases once it is rare. And once they don't print more of it or it's not printable, it becomes more demanding. And that was the structure that was factored into Bitcoin. So that was all that led to the financial crash and the need to have a system that is not quote and unquote controlled by the government, quote and unquote, that is not what else again, that is having a maximum supply that cannot be printed, and that gives everyone a fair of opportunity to get in, right, to the system. And so this was all that led to the creation of Bitcoin as a blockchain and then a cryptocurrency. So what is a blockchain? A blockchain is a distributed ledger technology. What does that mean? It simply means the blockchain is like a thrift collector's book that records every daily transactions of different participants all over the world, and that is transparent where everybody can see every transaction that goes in and goes out, and that stores several information which goes beyond storing transactions to storing items. Like the book can store items beyond what was written on it. It can store items. The blockchain can store items. It can store books. It can store PDF. It can store musics, making every storage or making every storing and every transaction unique with a signature called the transaction hash. So the blockchain is that bigger ledger that stores many things, transactions, or in fact items. But all of those items are also called transactions. That is the blockchain. So because of the blockchain, right? We can have cryptocurrencies, which are cryptographically created currencies, and cryptographic because they are encrypted with some mathematical codes and some computations, right? And so that is how cryptocurrencies came about, and that is the backstory that led to that. Now, those cryptocurrencies can be traded on crypto exchanges. I already mentioned some examples of those for us. Binance. What else again? I mentioned, Bitget. I mentioned, Coinbase. All of those are exchanges, and there are different ways of trading. There are different styles of trading. In fact, there are different types of trading. So there is, what trading is essentially. It's about you buying to sell or selling to buy. Buying to sell meaning you want to buy at a low price, you want to sell at a high price. Selling to buy means you want to sell at a high price so you can buy at a low price. Either ways, you buy and sell assets to make profits. Simple. Now, that also makes us to come to the types of trading. There is spot trading, there is futures trading. In fact, there is margin trading. But for the sake of this class, we would focus more on just spot and futures trading. What is spot trading? Spot trading is you buying the actual assets, that is cryptocurrency, for you to have direct ownership of that particular asset. Take, for instance, you found Bitcoin trading. One Bitcoin is trading on the financial market or a crypto exchange, say Bitget, one Bitcoin selling for 25,000 US dollars. And you feel, you know what? I think because of the current price of Bitcoin, $25,000, it is undervalued. I need to buy this asset right now because I think it will soon appreciate. So you bought one Bitcoin, $25,000 because you had the money, and then you told yourself you will wait for a moment, maybe about a quarter or a month, to sell once it appreciates. And thank God or thank goodness, whichever one you want to thank, it appreciated in value from $25,000 to 30. So when you sold that one unit of Bitcoin you got, you were selling that in one unit of Bitcoin within the space of 3 months at $30,000. That explains once you do the mathematics, doing the minus and plus, minusing your principal, $25,000 from the amount you sold the asset, you would see that you have netted $5,000 profit, isn't it? Yes, that's an example of spot trading. But this time around, you can not only have the asset, you also have the autonomy of moving the asset. So the one Bitcoin you bought, you can move it away from a crypto exchange to your crypto wallet and tell yourself, I'm just going to forget it. I'm not going to sell it at all for 10 years. You can do that because it is a spot trading, because you can move the asset. And that is a beautiful thing about spot trading, right? You can hold the asset for 10 years. You can decide to just send a fraction of it to a friend, say 0.05 Bitcoin, and you still have 0.085 unit of 0.095 unit of Bitcoin. You still have to hold, you still own that, right? But for futures trading is different. Futures trading is a contract trading, right? It's about you trading the underlying asset, right? Because what is called futures is a derivative. I'm going to explain. So you don't own the Bitcoin, but the exchange gives you a derivative of Bitcoin, which also is called Bitcoin, for you to trade Bitcoin, not with the allowance of owning the underlying assets, but for you to speculate on the price difference for a short-term profit. Now, take that again. Futures trading is a contract trading that traders engage in on a derivative asset of its underlying assets, allowing you to take advantage of the pricing of this particular asset within a specific time to profit of the movement of this asset. So the truth is, when you're futures trading, you don't own the assets. You're trading a derivative of the actual asset. It will have similar pricing, just maybe a bit of slippage. Say the pricing of Bitcoin in spot is $105,200. Its derivative, which is a futures Bitcoin, it will be called BTC. It will be called BTC USDT P. Maybe USDT perpetual or derivative. It will be called derivative. You will see it in a different category. If you head over to Bitget right now and you open your app, you would see that clearly there. You would see when you head over to Bitget, right, that the mid part when you click on trade, what that where that takes you is spot, where you see a session by the bottom right corner called futures. That is the place where you trade futures. It's very much different, and the pricing differs, right? The pricing differs. I'm saying this to just let us know very importantly that you know, futures trading is very much different from spot trading, and it's interestingly chilling. What I'm saying, I'm using the word carefully because it's chilling and surprising, because whenever you see assets that are in futures trading, you would always have the excitement to up on them to make money, because with $10 you could actually make $20. Very crazy. That's like 200%, right? With $10 you could make extra $20, right? That's future trading. But then if you add to if you and that's because you would be leveraging, and leveraging is simply that the platform borrows you fund. Say you get over. We'll do more practical discussions on this tomorrow. Let's say you got over to BitGet, and you were like, I'm having $20 I want to use to trade, and then you checked, you saw something like 10x. What that means is BitGet is going to borrow you 10 times for you to trade the market. So your $10 will appear in the market as $100 capital. And so when that particular asset moves by 2% on spot, if you had used $10 to buy, you would have profited 2% on your capital. So of course, 2% on your $10 capital means $0.2. But because you literally used a what's it called, a 10x leverage for futures, right? Your profit is more because you're using a 10x. That implies that when the market moves, when the underlying asset moves 2%, your futures trading account, or your futures trading engagement gets you to have a 10 times. That's 20% literally. So imagine a 20% on your $10. That means instead of you to get a $0.2 profit on just a short movement of 2%, you're going to be having $2 profit, right? That's it. So future trading is a contract trading that allows you to contract trade later at a set price. You literally can trade now, right? You literally can trade now with borrowed funds and have more profits for a specific period of time. Of course, a potential profit or a potential loss within a specific period of time. So spot trading is like you can see on the screen, it's like you owning a car. Futures trading is like you're renting with insurance. Spot trading is like you're owning a car. Future trading is like you're renting the car and then you're paying insurance. So you don't own the car, but you can quickly use that car. You don't. I mean, spot trading is like, so for you to make more profits on spot, you got to put more money. But for future trading, you just need small money to make more money, right? If you know what you're doing, in a sense, that's what it means. So because for spot trading, for you to own a car, you might need to spend like $5,000 in Nigeria to buy some maybe good cars or fairly good cars. But then to rent the car in Nigeria, you might just have to spend like $100. But then if you can get some persons to do some very crazy Uber drive in Lagos in a day, maybe you can eat 40,000 naira profit doing some very good Ubers, right? And you only spent but then you already spent $100. Only if that rentage is going to take you for 2 days. But I'm just saying that because the rentage is already above 150,000 naira. But then I'm just saying that kind of thing. I think you can even make more than I suggested. You can actually make about 200,000 naira if the person knows how to go about Uber. I don't know how that works. I'm just saying that. Just picture it that way. You don't own the car, so you don't spend more like $5,000. You're only spending a very small snippet to potentially lock in more profit. That is what differs. That differentiates spot trading from futures trading. Now that said, I think we need to head over to the next part, which is important. This is the core principle of the financial market. The financial market rises and falls on demand and supply. Demand is the point where people buy, and that's the point where the market goes up. Simple. Supply is where the market, where the market sell and prices go down. I wish I could pull up a chart for us. I think that could also be of help. Let me see if I can quickly do something like that for the purpose of this course. We have just about 14 more minutes. I need to wrap off everything so we can just end everything quickly. Okay, I'm going to be showing us a market chart. Okay, so I would quickly show us this chart so we can just let it load a bit. I'm just coming, just a moment, please. So this is Ethereum chart, and I'm going to be showing us something quickly on that. Share this StreamYard. Yeah, yeah. So I think this is already up, and then let me share this also for a minute. Now, I believe you all are seeing this screen. Can we all see this? Now, this is a 1 hour chat. I believe we all can see this. Yeah, great. It's a 1 hour chat, and what you all are seeing on the screen, interestingly, is there's a point where the market, was coming from, right? Like this point, and when it got to this point, which is a high point, it drops, and there's a point where the market was coming from at this point. When it was from this point, something happened, it bought. So this kind of point where the market is buying from is what we call, let me quickly write something. It's what we call a demand zone. Some call it support. They call it demand or support. Let me just write that by the side. It's called a demand or support zone. I believe you all are saying that because that's where the market is demanding, is buying from that point. When it got a bought, when it tried to come closer, it went up a bit. When it came closer again, it went up entirely. But then there is this place where if you, in fact, stretch it backward, you'd see that at that interval, it always drops. It drops, it drops like that. It drops. And then, of course, it drops, right? This tells you very interestingly that these points or these places or this kind of region, they are called a support, demand or support. They call it support zone or resistance. And I want you to picture a floor and a ceiling, right? A floor and a ceiling. And I think it's kind of important for me to make you realize what this is all about. If you look at the floor, right, imagine this being the ceiling. When the thing jumps to the ceiling, it definitely will come down. In Yoruba, we say "Lala to roki lelumbo." It's simple. Whenever it jumps to the top, it will drop down. Whenever it jumps to the bottom, it should go up. But now something has happened right here. It has broken this particular range. I'm not going to be doing analysis today. This has very sure meaning. This tells you that nothing is going to, counter the decision that this market is a bearish market. So bearish means a selling market, because when it was between this is called a range. When it was within this range, going up and down, it needed to break either upwards or downwards. And if it has broken upwards, we know it is a bullish market. But if it has broken downwards, that means no matter what we are doing in the next couple of months, we're still going to be seeing the market coming downwards. So that is very clear. These are fundamental things. And I'm not going to be talking about that today. But then this is just let us know what the market dynamics are all about, right? It rises and falls on the principle of demand and supply. And what we've just seen right there is a typical example, a picture of the support. I mean, the um the support level. I mean, what have I said? Sorry, the supply level. And I hope that wasn't what I wrote there. Oh, apologies. Let me bring us back here. It's called the supply. I was wrong here. This is called the, yeah, I wrote that twice. I mean, we didn't see this. This is support, and I'm not supposed to write support also here. This is called the supply, demand and supply, right? That's it. Okay. So that's the supply zone. That's the zone where selling takes place. Let me just put this here for the purpose of that's where selling takes place, right? And then the demand, that's where buying takes place, right? Let me just put this here so we can have that in mind as a mental picture. So I think this is of great importance for us to know. I'm going to drop the picture in the Telegram channel, right, as we are going on in this discussion. So I think that's very much interesting. So you can always check for the picture for demand and supply. I've made a copy of that, and this is very important for us to understand, right? That the financial market works on demand and supply. Whatever buys, we definitely sell. Whatever sell, we definitely still buy. It's a matter of time, and that's why you need to know how to play around with demand and supply and time. Time will be of great importance to you. So, like we've explained, many buyers want to buy, and that's where demand is. And then many buyers want to sell, and that's where supply is. But for the selling zone or supply zone, the market price goes down. For the demand zone, price goes up. Price is the balance between the buyers and sellers, right? Price is well, so it's like a tug of war. I want you to picture a tug of war. This person is dragging, that person is dragging, and the midpoint is where the price is. So the left side, take them as the sellers, the right side as the buyers. So when the buyer wins, right, in the financial in the trading market, the market moves up when we have more buys, right? Typically, that's what I'm trying to make us understand. The market pushes up. When the sellers win, the market pushes down, and the midpoint is where the price is, right? The chart help you to see the demand and supply and how it shifts. So I often call the chart the art beat of the market. And so as we've just looked at Ethereum, that's Ethereum chart, you would see how the market moves ups and down. And of course, the news, the different things that comes out, indicators that let you know if the market is going up or going down. So I have shown us what a chart looks like. This is this chart of gold. What you're seeing on the screen is gold chart from the 70s till the late later 2000, right? So I want you to know something very importantly, that you need to keep your eyes locked on different charts so you can understand where the demand zone and supply zone is. And that's my assignment for you after this class. Pick a chart. Say you pick Bitcoin or BNB. Those are the two charts I'm going to want you to pick. Pick those two, everybody. Just and where do you want to pick those charts? I'll tell you how you get the chart. So you will download the application called TradingView. In fact, that is too far. And get over to your BitGet application. You will see the chart there. When you head over to your BitGet app, go to trading, go to trade. When you click on trade, you would see whatever, maybe it will be XAUT or BTC, whatever coin you see. You will see a part there. I will drop a screenshot in the launch so you can see it's that part where you see a candlestick. I mean, you would see the candlestick at the top right corner. It's that icon you would click on that would open up the chart for you. I want you to open up that chart and just look at it. And as you look at it, play around with the icons on the BitGet chart. You'd see where you can turn your phone the other way around. But then if that is difficult for you to do, just simply download TradingView and sign up with your email, and then you would see the chart. Just look at the chart and use the icons, or use the icons, the rectangle icon, or the different icons you have there to mark out the demand and the supply zones. Whatever it is, you can just look at the chart and mark out the demand and supply zone. I know it's going to be tasky, but trust me, if you get yourself into it, you're already getting more learnings by drilling or driving yourself to learn more. I want you to look at that and check out and mark out the demand and supply zone so you can identify what footprint both buyers and sellers are leaving. So right, because when it comes to trading, you must learn to identify patterns, play with price, and that's where you can come into profits. You must learn to identify patterns. So I that's why I'm giving this assignment, right? So I think for this I would have loved to do this, but maybe I will just send a video now. You can set up your TradingView workspace. I'll send the video for that. It's a short video, so you can look into that today and then set up your TradingView. So because TradingView is the go-to app where we do analysis, and like what you've just seen right there the other time, this particular software, this particular interface is TradingView. I use this for analysis. I can actually literally show us the analysis I was making reference to that we gave about Bitcoin going down some few weeks ago, right? Let me pick the chart. It was on BitGet. So just to bring us to the place where we need to understand importantly that you cannot be a serious person with trading without having a solid, and I'm using the word carefully, solid understanding of the financial market. Let this thing load up quickly. You'll see what I'm saying. So you must have a solid understanding of the financial market. Okay. Yeah. So you can literally see we took advantage of both the buy and the sell. Where's it? I don't think it's a chart. Either ways, there you go. The buy, the sell. Anyways, I'm going to be coming back to trading view once we are done with all we're doing. That'll be tomorrow. So I would send the video on how you can set up a trading view and how you can make the most of them. So I think for these, okay, the practical session is going to be like tomorrow. I'm going to be showing you how you can, set up your portfolio. How you can set up your portfolio. I'm going to explain what that means. Oh my God. Yeah. I'm going to show you how you can set up your portfolio on TradingView tomorrow using CoinGecko. So CoinGecko and TradingView, those are the two applications you should download after this session. We're going to show you how you can set up a portfolio where you can have all your assets, the ones you are watching. You want to see how they're performing over the week, over 1 hour, over 24 hours, and you'll be knowing what decision you're going to be taking afterwards. But then this is practically all of the apps you need: BitGet app, TradingView, and CoinGecko, at least for the moment. Tomorrow we're going to practical session how you can set up all of this, how you can analyze the market, then how you can set up TradingView. I'll send the video tonight, then how you can build up a trading portfolio. That will be discussed also tomorrow. I think that'll be all. I don't know if there are questions and answers. So in essence, what we've done is we've looked at the history of money, its evolution into cryptocurrencies, the role of market and how trading works, spot and futures trading, how they differ from each other, demand and supply as a key foundation of the markets, and how these influence. We've given us assignments to pick up one or two charts. I think it's two charts, BNB and BTC, and to identify point where the markets demanded from and where the markets supplied from. Those are the assignment. I think that's literally all we've just discussed in essence, and that brings us to the conclusion. And I want to say thank you for joining and being a part of us in this BCB Cohort 3. So I want you to encourage your friends to bring to come tomorrow while we're going to be wrapping off the session. And so I don't know if there are questions. I want to say thank you once again. We can always unmute our mics now and talk. Thank you. Are there any questions? We're done. We're going to be calling this a close right now. So get back. So they create those coins and they tell people to get on it. And because they created the coin, you can be sure they have so much unit of the coin. I don't know if you get that. So they can create the coin. They will configure the amount of the coin they want to have in circulation. If you head over to CoinGecko and you search for Bitcoin, right, you would see Bitcoin. The maximum unit of Bitcoin ever in circulation is 21 million pieces. There can never be an increase or a decrease since 2009 that Bitcoin is launched. 21 million pieces. But these guys, when they create their coin, maybe they put 10 million pieces or 2 billion units. You can create any unit of your coin. I mean, now they will, because it literally has no value when it is launched. The value is maybe 0.00000 dollars. They can use $1 to buy about half of the whole coin, like 5 million pieces. And then they'll tell people, come and buy. And their in-house guys would have also gotten on the coin. I don't know if you're understanding this. So when people now begin to come into it and buying it, right? Those ones got in late. Those ones are literally pumping their bags. That's what they call it. Those ones are just buying some crunches because they have gotten the chunk of it, right? And because they have gotten the chunk of it, when this coin that maybe they call it baggy, they can call it any name, they can call it baggy. And this baggy coin went up to a value that is valued at $500,000 from zero. So because they're having half of that coin, or they're having one person bought half of the old supply, 5 million. If that person sells half of that coin, like, you can be sure the old coin will drop down. Do you understand? The chart will drop down because the person has so much than almost all the community. And now imagine that fear trigger coming alive. Once that comes alive, every other person begins to sell, and then, you know, the thing just goes down and then it never comes up. And then what happens is that they just they delete their account on Twitter, delete their account on Telegram where they have the communities gathered, and then they delete their videos they posted on, TikTok. And then that's what rug pulling is. Rug pulling is like someone is standing on a rug and then you pull the rug off the person's feet, the person's fall. And so that's what they do. And they do that through systems of either they buy the most of a particular coin, which they knew the intention is not because they want to solve a problem. The coin is not to solve a problem. It is so they can take advantage of gullible community of followers. One, two, some also do rug pulling by um, creating a coin that only allows you to buy, but you can sell. So everything you buy enters their own wallet, and then they can just take everything and then they leave the whole thing dry. That's why that's not a good thing to do. That's very, very wicked and heartless. So now, bullish and bearish, what that means. Bullish means the market is going up. Bearish means the market is going down, right? Bullish is just like when someone is like, when they, statement like it's like let's hold something by the bull on. Bullish just signifies strength. When something is strong, the horn of a bull is up. Bear does not have a horn and its mouth is down, right? So you know that bullish is like upward movement, bearish is downward movement. And that's just it. When people say I'm bullish on this particular asset, they're saying I have an expectation this market is going upward. There are certain tools that I think, and of course in the first market, I think we need to be aware of. You can always look up for this, and if I can, I will try and do a bit of sending across to us with the linguas that I use in crypto markets, right? The communications and the words they use, right? I don't know if you understand this, right? So this is yeah, this is how they go about, rug pulling people and what it is about. It's very wrong, evil, and it's because they have a bigger control of the assets, right? Yeah, it's unfortunate that sometimes we in fact have some Christians doing something like that, and it's all because of the deceitfulness of riches. So I hope that answers your question, brother. Okay, all right, perfect. No, no, it's okay. Okay, okay. No problem. We'll try and work around something before the end of next week. Thank you very much. All right. So, are there any other questions? So, in the absence of none, I think I want to say good day to everyone of us. Let's get out. Let's get on the assignment. Download TradingView. Download CoinGecko. Their mobile applications on your phone. CoinGecko. The names as mentioned. TradingView, CoinGecko, GECKO, and sign up on them to look into these charts. So just look into it and just tell yourself where is the demand zone, where is the supply zone. And I hope that when we meet tomorrow, we'll do more practicals. So on to the next. Please stay safe. And of course, don't let anybody deceive you into buying what you shouldn't buy. Don't buy what you don't understand, and ask questions more. I've had my own share of losses. I don't want to talk about that. And this is not because I don't do enough research. Losses are part of the whole journey, but it's important for you to learn so much. You must read and study so much, and then you'd see that it's a matter of time. You would be able to be financially prudent and be able to own up and take responsibility for your life. Your discipline is very important. Don't, because you've learned some things, so you want to go collect for that. I've been trading. I've never asked people to get out their phone, let me be trading for them. No. So there are step by step into you coming to your own kind of freedom in a sense. So on to the next. We'll meet again. Stay safe. Good night. Bye.